The start of 2022 has shown us that the speed of change seems to have no limits. If there ever was a time to fasten our seatbelts, now would be it. I'm Mark Kinney, Chief Investment Officer of Newport Private Wealth, with our first quarter update. In this presentation, I'll share insights on investment activity and the performance of some of our mandates, our portfolio positioning in the face of the volatile start to the year, and our thoughts on inflation, interest rates, a potential recession, and what lies ahead. We can't begin this review without first talking about the impact of the war in Ukraine. The humanitarian crisis has been devastating. More than 10 million Ukrainians have fled their homeland, and the world has responded in extraordinary ways. Although the enormous toll and destruction are ongoing, we remain hopeful that a resolution to the war will come soon. With conflict comes economic shockwaves at a time when markets were already unsettled and highly volatile. We've been talking about these trends for some time and have anticipated many that are now playing out. Although not new, they've left a lot of you in a state of disquiet and uncertainty about the future. Amid all this noise, it's important for you to remember one central theme: we've got this. Responding in the moment to the crisis du jour is not a productive strategy to manage your investment portfolio. While we can't position a portfolio for an unexpected war, much as we couldn't position it for an unexpected pandemic, what we can do is stick to our long-term plan and make adjustments along the way. That plan is executed by our highly experienced and seasoned investment committee, one that has been through many market cycles. It's why the wild swings of the quarter haven't surprised or distracted us. It's why we've been positioning portfolios for a rising rate inflationary environment since 2019, and it's why your portfolio is structured to be defensive in times like this. Activity in the quarter was low-key, in line with our view of where the best opportunities lay. The performance of some specific asset classes illustrates our plan in action. Let's look at bonds for starters. This was the worst ever start to a year for the bond market, as it fell 6.97%. If you consider that the average coupon is 2.83%, investors lost almost 2.5 years' worth of returns in 3 months. We've been positioning for this volatility since 2020 and warning about this since before the start of the pandemic. The current environment validates our strategy. Bonds are the primary component of our fixed income fund, and our managers hold bonds that are high quality with shorter durations to help protect against rising interest rates. Low yields do not generate meaningful cash flows. The substantial price risk associated with rising interest rates is also unappealing. We will remain well underweight bonds until we feel the rising interest rate cycle has played out. That said, as with every asset class, we constantly evaluate our position. If rates rise meaningfully and then stabilize as expected, our bond allocation may increase accordingly. It's a reflection of our fact-based and rational management approach. Our overall income exposure remains broader and diversified. This includes private debt, mortgages, and income-producing real estate. This portfolio of asset classes provides a better source of yield, is more stable, and acts as a hedge against inflation. We will continue to add to these positions as opportunities arise. Newport's private multifamily real estate investments are a cornerstone of our diversification. With exposure to 24,000 apartment units across North America, monthly collected rents provide reliable cash flows, and assets can be sold as property values increase. In certain instances, our private real estate managers trim positions in areas trading at elevated valuations. Capital will be redeployed in more attractively priced markets. We invested $20 million in Brookfield Supercore Infrastructure Partners, which is focused on transport, renewable power, utilities, and data sectors in developed countries. This has a 5% cash yield along with growth potential, both appealing in the current environment. The Newport Yield Fund was slightly down in the quarter, but up relative to its benchmark. This protected capital in an environment where the indices were down and the bond market collapsed. Real returns for this fund over time demonstrate the value of taking a long-term perspective. On the public equity side, there was a broad sell-off. Other than energy and financials, anything associated with growth sold off far greater than the market indices. While our managers were not immune to the sell-off, they remained confident in the long-term prospects for the businesses we own. Even with the impact on our portfolios, we don't expect there to be any permanent losses in any of our positions. When markets correct, we carefully add to our managers from cash on hand. Our total equity exposure in our balanced mandate decreased from 46% to 42% in the quarter. That's in direct contrast to the typical 60% equity, 40% bond portfolio held by most retail investors. It's a deliberate strategy that acts to minimize volatility and protect capital. It allows us to supplement growth from private investments, including real estate and private equity. The reduction in equities can be attributed to two things. One is market depreciation. The other is incoming cash that we chose to hold off on fully deploying. Smaller allocations were made to a handful of our third-party specialist equity managers. To take advantage of recent weakness, capital was directed to our Canadian dividend, global REIT, and international value-focused managers. You may recall we reduced our exposure to emerging markets late last year. We redeployed some cash in February with Sands Capital, our emerging markets manager, at better valuation levels. We will continue with a considered approach to further allocations here and with our other equity holdings. Identifying buying potential in the months ahead will be tempered by gauging market conditions as they unfold. I want to touch on three last points before wrapping up. The first is inflation. In a very practical way, we are seeing the effects of inflation in our day-to-day lives, at the grocery store, the gas pump, when we eat out. The cost of goods has certainly made an even greater impact this past quarter. We've protected portfolios well against modest inflation, but it's not a foolproof security blanket. If we get runaway inflation, there's going to be pricing adjustments across all asset classes. That's where the strength and considerable experience of our investment committee comes to the fore. Like a sailor who understands that a shift in wind may signal a coming storm, we prepare well in advance to batten down the hatches and change course as required. Our goal is always to find a safe harbor for your hard-earned assets. We can't predict where the level of inflation will go. However, we can and will proactively manage for maximum protection. The second is the role of cash in a portfolio. We've been carefully adding to and managing our cash position so that we can gauge and identify the right opportunities to invest across our asset classes. That gives us the ability to act as quickly as needed when we feel it is appropriate. There's a significant advantage for Newport to hold cash tactically inside the portfolio for committed capital and opportunistic investments. It gives us the freedom to invest wisely. That's very different than sitting with money stagnating in your bank account because you're fearful and trying to time the market. In fact, cash is the worst place you can be if you want to protect the value of your assets from inflation and the erosion that happens because of inflation. As Warren Buffett said, today people who hold cash equivalents feel comfortable. They shouldn't. They've opted for a terrible long-term asset, one that pays virtually nothing and is sure to depreciate in value. It's worth noting that this was said in 2008, another time of fear and uncertainty. A good reminder that we've been through periods of high stress before. As one of our managers noted, history has also proven that dramatic change is frequently less than we expect and likely will not persist as long as we expect. And lastly, let's talk about the possibility of recession. Newport is not in the prediction business, so I'm not going to forecast the likelihood or timing of a recession. Certainly, there are key indicators to pay attention to. The yield curve inverted in the quarter, and historically a recession tends to follow sometime after the curve inverts. A sharp rise in oil prices is also often seen as a precursor to recession. Yet it's worth recalling that unemployment numbers are strong. The rally in the markets at quarter end moved the S&P just down 5% from the all-time highs set in early January. 8 of 11 sectors in the S&P index expect to see an improvement in earnings relative to the first quarter last year. In other words, it's not all doom and gloom. We'll monitor, watch, and wait to see what transpires. All the more reason why it's important that we stay focused on what we can control and maintain our investment discipline. Be assured that your financial future is in safe hands and that your portfolio is prepared for whatever transpires. We thank you for your trust, your loyalty, and for the investment values we all share. On behalf of everyone at Newport, be well and safe in the months ahead.